So, what's the Fed's next step, and how might its relationship with the U.S. president affect its decisions? Let's talk about all of that with Ken Goldstein, economic advisor at the Conference Board. Ken, thanks for joining us. So, rates unchanged for now. Your reaction to today's Fed meeting?
I think it was totally expected, and I think it's going to be totally expected that next month they will indeed make another 25-point increase in the short end of the yield curve.
So far this year, the Fed has raised short-term rates 3 times. Expectations are that next year in 2019, it will be raised 3 to 4 more times. That's the talk. Do you think that's appropriate action given the current state of the U.S. economy and those recent unemployment numbers?
Absolutely. I mean, look, exactly those unemployment numbers lower than it's been in a generation, starting to increase wages. That's starting to put upward pressure on prices, and the Fed wants to stay ahead of that. That's why they've increased as much as they have. That's why they will continue to increase into next year as long as the labor market continues to put that kind of pressure on wages and therefore on prices.
Ken, we heard a lot of Fed bashing by U.S. President Donald Trump leading up to the midterm elections this past Tuesday, but now that's all over, as we know. Should we or could we expect more Fed pressure from the president, or was that just all political talk?
Look, the Fed is data driven by the facts that I just gave you. The other thing that they're driven by is by the market. And the market has put the long end of the yield curve, the yield on a 10-year bond, up above 3.2%. Those are the two things the Fed is paying far more attention to than anything that they're hearing out of anybody in Washington, D.C.
But we did see some recent market volatility. We've had this ongoing U.S.-China trade war. We just had the elections. And what about the global economy? What should the Fed do to maintain this balance with everything going on in the world?
That's exactly the point, because it's not just the central bank for the United States that's raising rates. We're seeing some increase really across the board. Interest rates have been extremely low. And so even with the increases the Fed has done, even with the increases anticipated next year, all we're doing is going from very low interest rates to low interest rates.
A lot of different reaction, though, when you have the borrowers and the savers. The savers are very excited about what's to come. Your take on that?
Well, that's exactly the point. Look, the U.S. economy is running hot. That is to say, it's running well above its long-term trend. It's going to start next year and perhaps into the following year to revert to trend. That's a natural process. That's different from an economy that's slowing down. And under those conditions, especially with inflation starting to potentially move higher, again, the Fed wants to stay ahead of that and also wants to stay ahead of the market, doesn't want to shock the market, and therefore will get a rate increase next month and several, 3 or 4 in 2019.
What do you say to those people who are concerned about a possible recession some point down the road?
There's a far bigger concern about the economy overheating than the economy slowing down or outright contracting, at least for 2019.
What kind of grade would you give the U.S. economy overall, taking into account the bigger picture here?
Again, look at what the market is grading, and the market is grading it at least a B, if not a B+.
Any long-term projections into 2019? Could we see any big changes to all of this?
Well, look, unless something big happens on the horizon, that doesn't seem that, that's likely right now. Where we are again is an economy that's running hot, and that's going to revert to trend in 2019 with interest rates going from extremely cheap to cheap.
All right, Ken Goldstein, great to hear your thoughts. Thank you for joining us from New York City.